All right, thank you very much, everybody. What are we calling it? A soft launch, guys? Is that what we landed on? Soft launch of a new company called Flux. There's no slides, by the way. I just think we have a cool logo. So that's basically it. I'm also going to aim to talk for pretty much as little as possible. I'm thinking maybe like 5 minutes. So 1 minute on just describing the company, 4 minutes. It might take a bit longer than that, I don't know, but on describing the product and what is hopefully relevant for almost, if not everybody here. So Flux itself is the kind of big picture, the blue sky vision is we want to be a Bitcoin native asset management firm. So we want to have investment vehicles where literally everything is Bitcoin. And two things there I'll tease out really quickly. So by which I mean not just everything is Bitcoin themed. So for example, probably you likely know me as a shit poster, I guess, but if not that, you probably know me from Axiom, which is a Bitcoin venture fund, very similar to Ego Death. Obviously not meaning to insult Andy in any way, because I'd be insulting myself as well, but Axiom I see as kind of this light in the sense that Bitcoin is a theme there, but we still do, and I assume this is probably the case for you too, Andy, right? That everything's still in dollars for like basically regulatory purposes, right? So that's not what we mean. What we mean is literally everything is in Bitcoin. So the NAV is in Bitcoin, the fees are in Bitcoin. The company itself will basically be on a Bitcoin standard, and that's what we are trying to encourage the recipients of the financing to do as well. The other point I wanted to bring up is what we even mean by Bitcoin financing. I'm sure some of the questions will probably dig into this a bit more, and it'll come out when I describe the product too, but we don't mean I have to be a bit derogatory here. We don't mean like LARPy, TradFi stuff where we're sort of eking out basis points, like picking up pennies in front of a steamroller by messing around in TradFi markets. We mean deploying Bitcoin where it is functionally needed. That's a good segue actually into what the product is. So we have a whole bunch of ideas, and we have two that we're starting with and to various extents kind of are live. We just haven't really talked about it. This is what I mean by soft launch. This is the first time we're talking about it. One is relatively more straightforward. I'll describe that just to get it out of the way quickly. So easiest way of distinguishing between these, actually, this is the language we use internally. Oh, sorry, one thing, I keep saying this, I forgot to even mention. The we is, Flux is a JV between Axiom, so you can speak to me about this. You can also speak to Matt, who's over there. He's also an Axiom GP. And Coin Corner, so you can also speak to Dave and Zach, who are right here. And we have taken investment from Folger, and I don't think either Oleg or Michaela are here. I would have thanked them if they were. So that's what has allowed us to go live. So the two products that we're starting with are very Lightning centric, hence this is the perfect audience to be talking about this. We refer to them as inbound and outbound. We'll probably have to come up with better names to make them make sense externally, but what we mean by that is from the perspective of the recipient of this financing, are you looking to receive either inbound liquidity on Lightning or outbound liquidity on Lightning? Now, the inbound one is pretty straightforward in the sense that what we're trying to build there from like a fund perspective is basically just an LSP. And it's more complicated than that when you really get into it, not even so much from the Bitcoin side, but more from like the finance side. But basically what we're doing, I've cleared this, so I know Jesse won't mind me shouting him out. The product that he announced like an hour ago or something like that, we want to plug that into a fund and then pump capital into it. So we want to just kind of like financial engineering and rhetoric to some extent to start sucking money out of TradFi and pumping it into Lightning. Again, there's nuance there. Please come and actually, you're probably better off talking to Zach about a lot of this, but come and talk to us if you want more information there. The one that's a bit funkier that I expect you'll all have more questions on is the outbound one. So this is a fun audience for this actually, because I can make this a lot more relatable than when I usually describe this, which is like much more abstract than I'm about to do. So can I get a show of hands? Who here is either a founder or a CEO or works for a company not in a technical role, but in say finance or business development? So I was kind of expecting almost everybody. Yeah, so like maybe 2/3 of the room. Okay, so of those people, well, the other people can answer too, but how many of you have faced the following problem? Actually, this is a really nice, follows on nicely from Andy's presentation. You're doing a venture round. It doesn't really matter what round, I don't think. This probably applies across the board. And you've had the following thought. You're thinking about use of funds, and maybe that's how you're sizing the round in the first place. you've got, okay, we have these capital expenditures, these operating expenditures, but we also need X amount of Bitcoin to put in our Lightning node because we are a quote unquote Lightning business. Who relates to this? Oh, good. I was really nervous. I wasn't sure. So, okay, cool. There's maybe like 5 or 6 hands went up there. So this is basically exactly what we're solving. And I'm going to skip over this because there's a lot of details that, again, can come out in questions. You can speak to us separately if you're interested in exploring like what we can potentially help you with. But what we want to do is avoid or help you avoid the need to dilute your equity more than I would argue you really should, on the basis that what you're doing in that situation, presumably you don't want Bitcoin as an investment per se. I would imagine that in the context of your businesses, you are massively over-levered to Bitcoin already. Not to say that you should like short it to try to get that exposure out or anything, but that the reason you need this Bitcoin, the reason you are structuring the round this way and diluting yourself more than I would say you need to, is because you need the Bitcoin kind of as this weird blur of an operating asset and of working capital. And the way I typically kind of describe this is that in context, that's sort of fine because you don't really have a choice. Like if you want your business to run, if you want to connect to the Lightning Network, then you need to do this. Out of context, this is completely insane. So you describe this to like a TradFi person, which I used to be, in the sense that you don't talk about it with Bitcoin language. You just talk about it with like general financial language. You're funding your working capital with rolling equity issuance, which is insanely capital inefficient. And so this is what we're trying to solve for. So the very crisp version of this, quote unquote product is that rather than you having to issue more equity than you need, we will have a fund that is entirely, as mentioned before, entirely denominated in Bitcoin, is basically just a big stack of Bitcoin. And we will lease you the Bitcoin that you need for this. And so this achieves 2 things. So the more obvious one is that the payback for this lease will be reverse engineered from being provably cheaper than you issuing the equity. And so the thinking is that this will be maybe it'll be attractive all the time, but it will be most attractive when you're doing an equity raise, because that's when we can do the calculations to make it like literally provably cheaper for you. The subtler one though, which I think is actually more important, is it's also not even provably, just obviously more flexible in the sense that you can give it back, right? You're just using it. It truly is kind of not so much working capital, but more of an operating asset, which is why we like calling it a lease. You're using it, and when you don't need it anymore, you give it back to us. You sell equity, that's X amount of your profits gone forever. You can buy back equity, but it's a mess. And so that's pretty much it. I mean, there's obviously a lot more I can say about both of these. We have ideas beyond that I don't want to confuse people with because it's going to be a while. The final thing I do want to mention. This is our like soft launch. Please do obviously talk to us about it. Talk to Matt, Zach, Dave. Tell your friends. Tell the other people in your company if you think it would appeal to them. Please don't tweet this. Please don't be like overly public about it because we're easing into, again, this is literally the first time we've spoken about it to any audience that isn't someone that is like potentially going to be involved. So a handful of people. I mean, I mentioned Jesse before. I don't see Marco here, which is unfortunate. Oh, there you are. Perfect. Right. So interesting other use case, just to give an idea of like hopefully how generalizable we think this will be. I've been saying Lightning the whole time. This is a Lightning event nominally, but I would argue that ARK has an even more serious version of this problem, or no problem, but it's a problem and an opportunity, let's say. And so we're very excited there about, similarly with the inbound one, we're going to be using Anboss to try to scale that up. One of the initial applications we hope for the outbound one is helping ARK scale up as well, because it's just going to be very, very difficult to source financing, I would expect, because of all the problems that we think that this addresses. And I think that's about it. I don't know how long that was. Hopefully it wasn't too long. So there you go. Questions? Have questions for the entire, 20, 25 minutes that are left. Yeah, go for it, Andy.
What's your actual setup for it?
Can you be a bit more detailed?
Entity regulation?
Sure, yeah. So it's just a regular corporation that's domiciled in the Isle of Man, hence the Coin Corner connection. which is great for, just to be clear, I don't like throw you guys under the bus. The real reason for the Coin Corner connection is their technical expertise. So the kind of rough split is the Axiom guys in this handle, and we're obviously going to start hiring people as well. This is a startup too. Axiom guys are handling the almost investment management decision making. Coin Corner guys are handling the technical apparatus. But a very sneaky byproduct of that is the Isle of Man is an amazing jurisdiction for this. So we spent an enormous amount of time, thankfully not that much money, but an enormous amount of time investigating jurisdictions that we could try to do this in. And I think this has probably changed we've been doing this for like 2-ish years now. I'm sure it has gotten better. It probably will gradually get better everywhere. But all of the ones that you might have thought were obvious were just prohibitive. For a handful of I won't even bore you with what the reasons are, but they're in the vein of like securities regulation, tax is a big one as well. There's probably even more boring ones than that. But Isle of Man is amazing for this. I think this is actually kind of, correct me if I'm wrong, but this is part of the reason you guys are even based there in the first place, because they're very forward-looking around all of this. So they've been great we've only kind of really started engaging with them, but they're great to work with. So that's the corporate entity. But the reason that regulatory connection is so great is that we're in the process of setting up just funds, just like a literal investment vehicle. The neat part, though, being that please correct me if I'm wrong about this, because I've been saying this and I don't want to turn out to have been false. As far as we're aware, these are the first vehicles, like globally, that literally are denominated in Bitcoin. So back to the very first point, they're not, maybe they have nothing but Bitcoin, because this kind of thing has been around for a while in a much looser sense of like crypto funds, right? Where they hold a whole bunch of Bitcoin, but they're still really dollar denominated, and they're still, they'll probably wouldn't have been based in the US, probably Caymans, but everything is ultimately still in dollars, even though they're doing stuff with Bitcoin. Isle of Man FSA has been amazing at, and we're not really there yet, so we hope we'll continue to be amazing at actually getting us to a point where literally everything can be in Bitcoin, which is obviously nice, like ideologically, it's kind of, it will, help with our own rhetoric to some extent, I'm sure. But it's actually really practically helpful as well in terms of what it is we want to do, because we only want to be deploying Bitcoin. We wouldn't have any use for dollars other than buy Bitcoin.
Yeah, it's super interesting.
Can you share all the research you did?
Research into... I mean, it basically amounts to like, this is a bad idea almost everywhere, because I'm not sure how much, honestly, I'm not sure how much more than that would really be helpful. Almost everywhere else that we looked, you get into I'll tell you the biggest one, it's the movement, how the movement of Bitcoin is taxed. So our whole pitch is this will make you more capital efficient. And even to some extent to like the LPs of these investment vehicles, it's a lot more straightforward from them. I skipped that because it's not really relevant to this audience, but it's just effectively yield on Bitcoin or outperforming Bitcoin. That is, both sides of this are completely undermined if you're taxed on a movement of Bitcoin as denominated in fiat. So that's yet another reason that we actually need the fund itself to be denominated in Bitcoin, because we get around this provided the regulator is okay with that, which this one is, but basically none others are.
Yeah, I think it's worth knowing as well, since Coin Corner, we've been on the Isle of Man for 11 plus years now, so we have quite a close working relationship with the regulator. There's a population of 8,000 people, and we've got a company there with 40 plus employees, so they do kind of listen to us and use our expertise.
Yeah,
to help shape the regulation.
yeah, we are under designated business over there, so we have meetings with the FSA about flux of the fund, so it's all green light so far.
Future, is very exploratory.
Yeah.
It's done very, very well, so that the concept like is a lease, so you really want to give like capital to startups, that they will manage as operating asset. But you foresee also like a setup where like potentially with new protocols, it will be a non-custodial kind of lease, which I know it's like kind of a weird, to say, but like it may happen, But
Yeah, we're totally open to that. I mean, the versions of these products I gave just now are, well, first of all, we're at a Lightning conference, so I'm talking about the Lightning ones. I think they're sort of self-evident, like if you went in the other direction. So bit of background on the business itself, one or two sentences probably, but realizing the need for this stuff, or at least the lack of it from a venture context, is the idea that became this, right? Because as mentioned, even in my previous job, I used to be like a TradFi investor, but now Bitcoin VC. So I see this all the time. I see like the use of funds charts, and it's like we're going to buy Bitcoin. So we went in that direction in terms of ideating this, like Lightning companies need this, and then kind of generalize from there. I think even if you went the other way though, right? So even if you're like, how do I have a fund that is only Bitcoin and what would I deploy it into? You'd probably land on the same thing because of all the sub-ecosystems, if you like, within Bitcoin. Lightning is, I don't think this is remotely controversial, Lightning is by far the most developed. And also this problem is pretty general. It doesn't really matter what you're doing with Lightning. So it's not like, for example, this isn't a product for LSPs. LSPs, I'm sure, would be great, recipients of it. You basically just need to want to make payments. As you want to use Lightning at all, you probably have this issue. So it's a very obvious starting point, but what you're asking is, well, you actually framed it in more of from the sense of like technical development. So I think I'm not the best. You're better to opine on that than I am. I don't particularly want to. But even from our own kind of business development, we have other ideas about what might work. And this is enough to start with, though. So
maybe a follow-up question would be I mean, I guess, also the procedure would be the classic, KYB or like in class, I guess, that's a lease, so that's important. So I think the non-custodial aspect is also like trying to have a new kind of model that don't exist yet where, yes, I think KYB is interesting, but like you have way less, requirement or new requirement. That's the interesting aspect.
Yeah.
It just have more food of thoughts than a question.
Yep.
I came in halfway here, so I may have missed it. But what are the terms on the leasing?
Yeah, good. I deliberately skirted over this because it's I don't want to like scare anybody off. I think the more important point, it's not like it's incredibly complicated. It's that it'll probably change between recipients. It'll be quite. We try to avoid using terminology that suggests it's debt, but it's kind of unavoidable here. Like the credit profile of the recipient will dictate a lot of the terms. But I'll just like make one up to give you an idea. So. Well, even on that point, actually, another reason that we're very adamant about calling these leases and not loans, this is where this comes from. Like, we don't want it to be misconstrued as debt. It's partly regulatory. It just makes it easier. That's kind of a cop-out, though. I think the more important kind of fundamental reason, the technical reason, is we want the paybacks to be more aligned the incentives around the paybacks to be more aligned than with debt. So I realize that this is going to be like a little bit of a long-winded answer, but this is what I wanted to avoid going into in the presentation itself. It's arguably more important to understand why we don't want it to be debt than what we do want it to be, because there's quite a few options of what it could be. So the reason we don't want it to be debt is that we think the incentives are poorly aligned on both sides. So it doesn't suit either party. It doesn't suit us because we are giving up custody of the Bitcoin in order to facilitate this contract, which from a Bitcoiner perspective, you could say is like the riskiest thing you could possibly do. We therefore don't want our upside to be capped. We want to be exposed to greater than, whatever you might think is like a quote unquote fair interest rate. Another way you could think about that actually is that if we did want to be compensated for the risk with an interest rate, you would probably have to set the interest rate so ridiculously high. You'd think in terms of like payback periods or something like, we may never get this Bitcoin back, so how quickly do we get paid back such that doesn't matter? And where you end up quite quickly is, I don't know exactly where an individual would choose that number, but call it like 30-40%, so you're paid back within 1 or 2 years. That pitch then makes absolutely no sense to the recipient, because what we're trying to say to them, like the whole problem we're aiming to solve is we want you to be more capital efficient. And we then turn around and like, cool, we'll loan you this Bitcoin for 40% in Bitcoin, by the way. Well, absolutely no, that's completely insane. So it doesn't suit us, the quote unquote lender or lessor. It doesn't suit the company either, because not only does it leverage them, which is arguably very unsuitable, as like almost all the recipients of this, like the natural recipients are startups, hence it's like this audience. Having even dollar leverage is probably not a great idea, but having Bitcoin denominated leverage is almost certainly a very, very bad idea. Like you're not really solving the problem. You're just piling on risk when we're trying to de-risk their balance sheet. Like that's ultimately the point of this. So understanding why it's not debt, arguably more important than then what we do want to think about offering. The two obvious ways are the payback is a profit share or the payback is a revenue share. I won't go into like this really is getting ultra detailed. We can talk about it later if you're really interested. Profit share is cleaner to calculate. Profit share would be preferable, basically. But again, startups, not all profitable or not all consistently profitable. So a revenue share is kind of a next best option that does work for them. And so immediately you can see that actually, this is what I mean by it's much better aligned. The problems of the debt completely go away. So on the fund side, we are exposed to their upside. So we're more comfortable with the risk than we would otherwise be if it were capped. And on the company side, they're not levered anymore. Yes, they're potentially giving away some of the upside, but in a much safer way in the sense that they're not taking on undue risk. So if they do badly or do less well than they expect, what they owe us comes down to accommodate that. So that's what we figure is more appropriate in this context.
Who do you see as primary LP for this? Because obviously the returns will be smaller than other.
So yeah, it's a very good question. On the
risk profiles.
On the inbound side, I wouldn't get too carried away with this now, but if it like really works, right? If we get all the regulatory stuff and the fund construction stuff set, and we're happy with how that's going to work, we're happy that having trialed it for a while, there's enough potential recipients of it. I basically see this as, again, this is like super blue sky. This is the best possible scenario. It's competition to ETFs because it's roughly the same, but you can actually argue it's a better security model because there's only one IOU involved, right? So it's not like an IOU on Bitcoin. It is still an IOU because we have to have custody of it, but we never give up custody, right? So it's an ETF, but where they actually get a bit of a payback rather than there's some, I don't want to go into, I think ETFs are stupid, basically. Probably most people here agree with that, but that's who we'd want to be competing with, so that's more straightforward. The outbound side, it's much more of an open question. It's in very vague terms, anybody who wants yield or wants to outperform Bitcoin and is willing to take that custody risk, which is kind of an odd one because I'm not sure I necessarily approve of that in a lot of contexts. But if you look at, the past 4 years of things I've been mocking on Twitter, clearly the demand is there, right? We know that there's, I would say probably in the order of tens of billions, maybe not hundreds of billions, but tens of billions of dollars worth of Bitcoin that is willing to do that. And so this is right back to what I mentioned at the start. I would much rather than see that channeled into like LARPy fiat nonsense, probably around the ETFs, because I'm aware of some use cases there in terms of like eking out a yield where you're basically just doing repos with ETFs to help their liquidity. Like, I want to construct something that funnels it all into Lightning instead.
I think the risk model is very potentially complicated.
Oh yeah, absolutely, yeah. So I'm glad you didn't ask me what's the return going to be because I have no idea.
Because any number you tell us, it's just out of your ass.
Exactly, yeah. It's until we've done it, until it's run for, arguably like a full cycle. I would say at least 4 years. I don't think we'll really know.
Yeah, exactly.
Yeah.
That's why the risk model is very risky because first you want to price it for it to be affordable. So it's almost like, it's complicated because it's
it is.
party over third party. So your risk modeling influences the risk modeling of the LP.
Yep.
So it's,
I was thinking, so this is probably halal as well.
Yes, well done.
For the Muslim finance
It is.
folks,
Is there any insurance required by the?
Oh yeah, that's a good question. So I don't expect there to be in the near future, but I also have to be careful here because a lot of the conversations that have led to me knowing the answer, I don't think the other people would want to be public. There likely will be relevant insurance on this in 5 to 10 years time, but there isn't the capacity to do it now, which if you think about it makes perfect sense because the reason this is exciting, at least to me, is that this doesn't exist at all right now. So no insurer is gonna, it's actually an even worse version of this problem, right? Because they literally can't price it we need that cycle's worth of data before we can give it to them, and probably competitors that have emerged by then too, before any insurer would, in their right minds, consider this.
Yeah, because I guess it's an operating asset, but again, if I'm operating a Lightning node or whatever, I mean, I can lose those assets, by actually theft or
well, so there's an interesting angle here in that, again, I'm wary of getting really, really into the weeds, but the way that we want to structure the contracts of the leases is such, and also in combination with how it's intended to be used, I have to be very careful. It obviously doesn't completely guarantee that the principal will be safe, because they can just run away, right? Hence, we require the return profile that we do to accommodate that risk. But the scenarios in which there is risk to the principal are actually fairly limited. They're a lot more limited than in a traditional loan, basically because of the way that it's intended to be used, right? So regular loan, you give somebody money, they then buy stuff, right? They buy productive assets, they operate the assets, they try to generate a return, and hopefully that return is higher than the yield they're paying you. And the way you price it is by assessing the risk of every single one of those steps. In our case, not only are they not spending the Bitcoin, they actually can't. That is a condition of the lease, that they may not spend the Bitcoin. They have to put it in a Lightning node, and we audit it constantly. And then there's this is what I don't want to go into too much detail about. There's various conditions around, if the node balance goes too low, the payment goes higher, and things. And even there, it's that depends on a case-by-case basis, what we think they need operationally, how risky we think they are, just in general, blah, blah, blah. This is where it gets really complicated, is why the answer before was it really depends. But in almost every case, if they're doing what they said they would do, the principal should not be at risk. The only reason it actually would be is incompetence or fraud. And obviously that's still possible, so I can't be hey guys, totally risk-free. It's absolutely not risk-free, but it has a very interesting risk profile that I'm not sure, I think it's novel. I don't want to be too grandiose about it, but I don't think anything quite like this exists in TradFi, which is fun.
I think you might be discounting the protocol risk.
Oh, yeah, sorry, there is also protocol risk, yes.
You can do everything right and still
I should mention that, you're right, yeah.
on Lightning.
Yeah, there's protocol risk. So there's incompetence, fraud, technical risk, let's call it.
So
If I'm speaking to TradFi people.
yeah, it makes,
Yeah.
since if you consider it an operating asset, I think it has a different profile, given that there's inherent risk of just bad implementation.
Yeah. Yeah.
You can lose a decent chunk.
So the other,
of
I was hoping to avoid this because again I don't want to go into too much detail, but to give yet more detail on the way the lease contract is structured, so following on from this, for those reasons, should the principal ever actually be imperiled, and we're into the conditions of default that we have set out, the punishment to the recipient is some version of, and again, there's case-by-case criteria here, but some version of, we get issued their equity at way more expensive than the problem we were solving for to begin with. So the point there, we don't actually really want their equity, we probably try to sell it back to them, but the point being that you have a major disincentive to do anything other than what you said you were going to do. So if you do what you said you were going to do, even if your business sucks, by the way, this is the point I was making about, it's it's novel in this respect. Our return could be completely imperiled. You could just lose money forever, never pay us any, we get zero yield from this. But if you're still behaving honestly and there's no, catastrophic protocol failure, then it should be fine. If you go into the crisis scenarios, we should still be okay-ish. At least it's unlikely we'll lose 100%. We may not make whole, but that's fine. The whole point is that's what motivates the return structure across the whole portfolio, that we need some exposure to upside to offset these risks. Because I'm sure every now and then there will be a default. It would just be stupid to assume otherwise.
Feels like venture capital companies are not necessarily the best recipient of that, given that you actually want to work with businesses.
That's a really interesting point. So we have talked about, this is also in the bucket of
Depends on the stage.
what other products do we want to eventually get to, and we're only doing 2 to start with because we're a startup, so we can't do absolutely everything. I agree with you that VC-backed startups are quite risky to do this with. However, they're currently the only ones that have this need. and they're also in a position to offer enough potential upside to offset these risks. So, I mean, we'll see. Yeah, maybe it doesn't work. That's entirely possible, but I'll give the same talk in 2 years and we'll.
Even a lot of startups, once they get to a certain phase, would have venture debt, for instance.
Mhm,
In the US, so secured over
Yeah.
certain of their assets. So to me, this is sort of similar to that.
Yeah, I think so. Yeah. We actually, without doxing them, we started hiring people for this, and one of them is extensive career in venture debt, who is also a Bitcoiner, and hence gets it. Jesse.
What are your thoughts on where
I don't know where we are for time, by the way. Sorry.
would fall in the
Oh,
seniority of
very good question. Matt, do you want to take that?
Senior for which party? For
I'm at time, by the way. I don't want to steal the next person's slot. Cool. Thank you very much.